Um, Hello guys, welcome to my channel. Today I want to be looking at liquidity. Now liquidity is simply money. Liquidity was or has been explained over time and time again. Kudos to Michael Hudson, kudos to Solomon Kings. But I want to try to do my own explanation in my own little way. Now there are two types of liquidity. We have the external liquidity and the internal liquidity. Now, liquidity means money. When we say external liquidity, now the candlesticks that we are looking at has three main bodies: the body, the upper spike, and the lower spike. So between here, like if you take for example this region here, if I use a trend line to take note of this region, that's this region here, then this range that I have here, the candle is in an internal range liquidity. Now, when this range, which is the highest high in this auspices of this candle, is broken, then this becomes the external range liquidity. Now, for the internal range liquidity, that is where we have where our order block, fair value gap, and liquidity void. But for the external range liquidity, that's where you have where are they found? External range liquidity is found in old highs and old lows. That's why the external range liquidity, you're going to find them here, which is close towards the old highs you have here and the old new highs that you have here. When I say here, so what the market did was, this was a market structure, which was a structure that was initially broken. So when the structure is broken, this becomes the internal liquidity. Market goes out here and breaks that structure, that is, goes from internal liquidity to external liquidity. That's where the market moves. So liquidity is the main driver of the market. So anytime the market breaks a structure means close a body of the candle closing above the wick, then it comes back to that range and draws liquidity. So here, the market has taken liquidity here. So coming out here, which is to the external range liquidity. And when I mean external, where is external range liquidity found? It is found in old highs or old lows. So all these places are regions of liquidity. And you saw what exactly the market did, came here and ate out liquidity. So that is how the market moves. That's why we say liquidity is the main driver, is the main push, is the main car that drives the market. So we have two types of liquidity, like I said: external range liquidity, internal range liquidity. The external range liquidity is found in old highs and old lows, while the internal range liquidity is found, that is, what you find in internal range liquidities are order blocks, fair value gaps, and liquidity void. I'm going to make videos on all that in my next set of videos. So that is that. Let's come and look for it again. So we have here highest structure that market has formed. Or let's come here, between here and here, we have market structure here. And here, what do you observe? The market broke the structure. So when market broke structure, so this breaking, this candle that closed below this spike of this candle is the break of structure. So this place is the internal liquidity, and this place is the external liquidity. So the market moves in the region of moving from internal liquidity to external liquidity, internal liquidity to external liquidity. So let's check for more examples. So we see what happens. This repeats itself time and time again. So you have here the trend line here. So that is this candle spike. What do you observe? There is a break of structure. So when the structure breaks, some people call it change of character. When the structure breaks, candle breaks towards the downside and comes back to fill back. So when candle, so that's the way market moves, from internal range liquidity to external range liquidity to internal range liquidity to external range liquidity, back and forth, and that's how market moves. I hope I've been able to explain what liquidity simply means. So that is what liquidity is. The market will always draw money. The smart money guys, the big guys, they are not in a hurry. When they place orders, they wait until their orders get filled. So even if the order doesn't get filled, that's why they come to various areas of liquidity to swap liquidity. So we saw what happened here. So this is what I mean exactly. In this region where we have the highs here, So above this place, where all these places are where the liquidity is. So have it at the back of your mind that liquidity is money, and the market moves in two forms. That is the internal range liquidity and the external range liquidity. I hope I've been able to try to do some justice to what liquidity is. So don't forget to subscribe to my channel. See you in another video.